Welcome to the Explainer. We've got a really interesting one today from Omnicom's latest earnings call. It's one of those classic puzzles. The company beat expectations, but the stock basically shrugged. So let's dive in and figure out why. All right, so here's the setup, and it's a bit of a weird one. On the one hand, you have a really solid quarter, a clean beat on both revenue and earnings. But on the other hand, the stock barely budged, even dipped a little. This disconnect right here is the entire story this quarter. So what is really going on? Okay, so first things first. The first clue is in the headline numbers themselves, which on the surface should have been great news. Let's take a look. So the numbers themselves, pretty solid. Omnicom reported adjusted earnings of $2.24 per share on revenue of $4.04 billion. Both of those numbers topped what the analysts on Wall Street were expecting. You know, normally that kind of performance gets a nice little pop in the stock price. But not this time.
And that's because, as soon as you start to peel back the onion just a little bit, things get, they get a lot more complicated. Let's break down where the money is actually coming from by looking at the different business segments.
And boom, here is the big issue, right here. You've got this tale of two companies living inside of one. The main engine, their media and advertising business, is just roaring ahead, up a super healthy 9.1%. But then you look over at their experiential business, and it's down almost 18%. That's a massive drag. It's like trying to drive a car with one foot slammed on the gas and the other on the brake.
Now, of course, management had an answer for this. They were quick to point out, hey, look, last year was unusual. You had the Olympics, you had a major U.S. election. Those are tough acts to follow. They argue that if you just strip those big one-time events out of the equation, the real underlying growth was closer to a more respectable 4%. And we see that same kind of split personality when we look at things geographically. The U.S. market, solid growth, up 4.6%. And Latin America, wow, it was on fire, up over 27%. But even that incredible performance couldn't completely paper over the weaknesses they saw in Europe and the Asia-Pacific market. Okay, but here's the thing, and this is probably the most important point of this entire explainer. The market, it really doesn't care that much about these quarterly numbers. No, investors are looking way, way past all this, and they're focusing on what is, without a doubt, the single biggest event in the company's entire history. So if the Q3 numbers aren't the main event, then what is everybody actually watching? Well, it's all about one thing, the massive industry-shaking acquisition of their competitor, Interpublic Group, or IPG. And look, this isn't just about getting bigger. It's about creating an absolute titan, combining massive data sets and creative power to try and reshape the entire industry. And CEO John Wren, he made this crystal clear on the call. He's framing this whole deal as a powerful platform designed to accelerate growth. He even confirmed they're expecting to close the whole thing by the end of November, just waiting on that final green light from the EU. So you see, the whole narrative is shifting away from last quarter and toward the next chapter. Whenever you have a merger this huge, there's one word that Wall Street gets obsessed with, and that word is synergies. It's really just a fancy way of talking about all the cost savings and new ways to make money you get by combining two companies. And what's important here is that management sounded super confident that they're going to blow past the initial synergy targets they've already announced. So this is basically the treasure map for investors for the next few months. These are the three big milestones everyone's waiting for. First, the deal has to officially close and day one of integration begins. Then they need to show us the plan. How are they actually going to get those synergies? And finally, the big one, the first combined financial guidance for 2026. Everything hinges on these three steps. All right, so with everyone's eyes fixed so clearly on the future, let's quickly touch on what management had to say about the rest of this year and what the analysts were really poking at during the Q&A session. For the remainder of 2025, it's pretty much steady as she goes. The company kept its existing guidance exactly the same. They're still expecting to finish the year with low single-digit organic growth, which is right in line with how they've performed so far. So really, no surprises here. You could really tell what was on the analysts' minds from their questions. Yeah, they asked about AI, they asked about some of the soft spots in the business like precision marketing, but the question that kept coming up again and again was all about timing. It was when. When are we going to see the financial roadmap for this new combined company? That's all anyone really wants to know. So after digesting the quarter, the commentary, and the big picture, let's put it all together. Here is our take on what to expect next. Look, we fully expect Omnicom to hit its Q4 targets. That's not really in question. But the stock,
We think it's probably going to be stuck in neutral for a bit, what we call range-bound. The market is just in this holding pattern, waiting for hard numbers on the IPG integration. And for that reason, we're assigning a market perform rating. Basically, we expect the stock to perform in line with the broader market, no major moves up or down until we get more clarity. So here's the bottom line. The investment thesis for Omnicom is no longer about whether they beat or miss earnings by a few cents in a given quarter. It is now 100% about one thing. Can they successfully execute this transformative deal? If they nail it, the potential upside is huge. But let's be real. The risk involved in pulling off the largest merger in the industry's history is just as significant. And right now, the market is just holding its breath.
This is not financial advice.